If you keep taking trades that look good at first, but then fail almost immediately, this video is for you. Today, I'm going to show you 5 simple ways to filter out bad trades before you click buy or sell. And at the end, I'll give you one bonus question that can completely change how you view liquidity and stop hunts. Most bad trades are not bad because your setup or analysis is terrible. They don't work out because the context is wrong. Price may be in the wrong part of the range. Correlated markets may disagree. Liquidity may be sitting in a more opportune place, or you may be simply reacting emotionally. So instead of asking, can I take this trade? A better question is, what should keep me away from this trade? Let's break it down. 1. Premium and discount. This one's a bit elementary, but worth repeating. First, ask where price is trading inside the current range. The midpoint of a dealing range is often called equilibrium. Price above that midpoint is categorized as premium, and price below it as discount. Traders and algorithms use this framework as a way to judge whether price is relatively expensive or cheap within a swing. If you want to go long, but price is already extended high into premium, that may be a bad trade location. Or if you want to short, but price is already in deep discount, that may also be poor. This concept does not predict direction by itself, but it helps you avoid chasing entries at inefficient prices. In simple terms, don't just ask whether the setup looks good, ask whether the price looks good too. Remember, there is almost always a retracement to a more efficient entry, which can help limit risk. 2. Correlated asset analysis. Next, check whether related markets are confirming your idea. Correlated asset analysis is simple. If you're trading one instrument, look at other instruments that usually move with it, against it, or help reveal a broader risk sentiment. For example, trading indices, NASDAQ and S&P, or metals, gold and silver. If your chart looks bullish, but a correlated asset is not supporting the same story, that mismatch can be a warning sign. For example, if one market is pushing a new high, while a closely related market is lagging, stalling, or moving in the opposite direction, that can suggest the move lacks confirmation or your timing is off. Maybe a correlated asset hasn't yet rated a pool of liquidity. You don't need perfect alignment, but when the asset you want to trade is saying one thing and the surrounding market is saying another, or might have a little farther to go to engage liquidity of its own, that can be a reason to stay patient. Bad trades often happen when traders isolate one chart and ignore the bigger picture. 3. Smooth relative equal highs or lows, with an imbalance above or below. This is one of the easiest filters to overlook, but it's also easy to identify. Relative equal highs and relative equal lows often look like support or resistance when in fact they act like magnets because liquidity tends to rest around clusters of stops. So if you see smooth, clean equal highs, be careful shorting directly beneath them unless the market has already taken that liquidity with a sweep and shown a reason to reverse. And if you see smooth equal lows, also be careful buying directly above them. Adding one more layer, look to the left. Is there an imbalance above those highs or below those lows? If there is, price has a strong reason to keep reaching into that area before your trade idea ever works. A lot of failed entries happen because traders enter before the market has finished reaching for liquidity and or rebalancing inefficiency. When coupled with the concept of premium and discount, this can become a powerful narrative that price will want to revisit these zones later, and if you're in too early, your liquidity too. 4. Equilibrium. Equilibrium is the midpoint of the range, often treated as fair value. Why does this matter as a filter? Because trades taken exactly around equilibrium can be harder to manage if the market hasn't shown a clear reason to move away from that center. You're essentially guessing market direction and taking on unnecessary risk. The middle of the range can become chop, indecision, a transition zone. So if you're entering right at equilibrium with no displacement, no liquidity taken, and no confirmation, you may just be entering where price is most balanced instead of where it is most favorable. Sometimes the best filter is simply this. If price is stuck near the middle, wait. Ever hear of don't fiddle in the middle? One exception here, if you've seen displacement away from equilibrium and your entry is a revisitation of the level, you may be onside and on time. 5. The feeling that you must enter right now or you'll miss it. This one is psychological, but it's probably the most important filter of all. If you feel like you must enter right now or the opportunity will be gone, you may not be reacting to the setup, you're reacting to a fear of missing out, or FOMO. FOMO-driven entries often happen when urgency overrides predefined criteria and is impulsive, acting from emotion rather than plan. A strong move can make you feel late, but that feeling alone is not a reason to trade. In fact, urgency is often the warning. Good trades usually let you explain your entry calmly. The location is right, the liquidity story makes sense, the correlated markets agree, and risk is defined. Bad trades often sound the opposite. I just don't want to miss it. If that is the reason, step back. The market will be open tomorrow. And here's the bonus question I want you to ask before every trade. If this moves a little farther against the obvious crowd, whose stops are sitting there? And if I enter now, am I becoming the liquidity that a more patient participant wants to use? In other words, can you see the market as if you're to be the counterparty to other participants' stop orders? Many traders place stops in obvious places, above equal highs, below equal lows, beyond recent swing points, or around very visible chart structures. And that creates pools of liquidity. If you enter right before price raids those levels, you're more than likely stepping in as additional liquidity rather than being the counterparty to those market stop orders. In other words, if you are not entering after the market has done its work, which is to facilitate trade and offer fair price, you are entering right before it uses everyone's stops to do so. That question alone can keep you out of a surprising number of bad trades. It also helps you identify where most people are going to get trapped, even if they were directionally right. Ever heard the advice, place your entry where you would have placed your stop? So here's the full filter checklist. Number 1, is price and premium or discount? Number 2, do correlated assets confirm the idea? Number 3, are there smooth equal highs or lows with an imbalance still calling price higher or lower? Number 4, is price stuck at equilibrium? And number 5, are you entering because of a valid setup or because you are afraid to miss the move? If you can run through those 5 questions before every trade, you will likely avoid a lot of low-quality entries. Sometimes the best trade filter is not finding reasons to enter, it is finding reasons to stay out. Also remember, a missed trade is always better than a loss. If you found this helpful, comment below with the filter that saves you from the most bad trades. And drop a like and subscribe for more market psychology hacks.